Okay, yeah, this is on page, you don't have to pull this up. This is on page 2. But
Right.
right now for this one, we're going to do the, SADI is the acronym, but but we're going to do just SNA. Why? Because we don't have any dividends yet. We don't have any income and we don't have any expenses because there's nothing on the income statement, or it's on the same day we bought it. So we're going to consolidate, and we're going to take out the stock and the excess assets.
Mm-hmm.
And here is why. It's kind of a theoretical thing, but this investment account is really the bill company. This is the bill company.
Right. Because that was what they paid, was the $9,600.
Yep. So if we consolidate all of Bill's, the bill assets and liabilities and all that, and we still have this on the books, we're going to be counting Bill twice. So Bill will be here, and we'll have Bill all here. So we're going to do what they call consolidating entries. Sometimes they're called other things, but for the most part, they're entries that are done on the parent company's books. So these are going to be done on N Company's books, or Amy Company's books. And they are to adjust for the consolidation. Once a consolidation is done, once we put them together, then we reverse all of these out and start all over, because Amy Company and Bill Company are really operating as two separate companies.
Mm-hmm.
So these are temporary journal entries that we put on the books to adjust for this other company. So here's what would happen when the company, when they make their financial statements. Amy Company would make her own the company's own financial statements, and Bill Company would make their own financial statements. Amy Company, however, would also have to have a consolidated financial statements, putting Bill Company on the books, because it all goes by control. So even if it was anything over 50% ownership, now in this case it's 100%, and that's good because it's a lot easier to do. But yeah, so here's what we're going to do. We're going to take out some things from the Bill Company, and we are going to eliminate that investment account.
Mm-hmm.
Now, if you think about it, this outstanding stock down here in retained earnings for Bill Company, that's not owned by the public. That's owned by Amy Company. It really doesn't exist as far as separate owners. So what we're going to do is eliminate,
because they have the 100%.
Exactly, we're eliminating it. And but here's a weird thing too, though, is that even if it was only at say 55%, you would still take 100% out because you control the whole company. We make adjustments later on for the other people's ownership, but we're not going to get into that now. So anyway, Amy Company and Bill Company, they have this, and so these are on the books. These are all on as credits. So we have to get rid of them, and we're going to get rid of them with debits. So
that makes sense.
So all of these are going to all these are going to go away. So this is the S in the SADI. So here's a little note. I'll put it in S's. Let's make these colorful. Let's another cool thing about Excel is you get a lot more colors for the to fill in. There, look at that.
Yeah.
It's gonna be that kind of goldish color. Remember that. That's on the test. All right. So we are going to take that out of the investment. So this investment will have a debit balance. We're going to get rid of a total of whatever those three are. Oops. And 8,160. I think that's what you got.
Wait, what's the 8,000? Why isn't it the 960?
The 9,600. Good question.
9,600.
Yeah, because we're going to have to do the assets too. It's sort of like, so here, this is it at book value. So at book value, the book value of what they bought was 8,160. But these up here, I'm going to add them up just for kicks. Ooh, look at that, it's 1440. Yeah, I hate that when I do that when I come out exactly the same. But anyway, so here's what we did. We bought everything. So this is everything at book value, and then the excess amount is going to be whatever that is, 1440. And so so that's going to be the second thing we have to take off. All right, so the stock comes off, and this comes off at book value. These are all book values, so these are all book values. But then we have to do for the assets. So we have to go up here to these assets and add on the excess. So 240. So inventory gets an additional. Oh, I want that. Inventory gets an additional. So this is the A and Sadie 240. Oops. Land gets an additional, I just leave it up there, 480. And buildings gets an additional 720. I'm going to make those all the same color just because. So all of these will then 1440. Uh, 1,440. So hopefully those come out to 960, and they do.
Okay, so because that's the over the excess value, then plus the book value of the purchase.
Exactly. That's exactly what it is. It's the excess over it. And again, they don't have these assets on at fair value, so we have to add those on because that's what we bought at fair value. So these will all be added in. The investment will disappear to go down to zero because we don't want to count it twice, basically. So what we're going to do now is we're going to add across. So I can see my screen. Okay, so plus 60. Just for kicks, I'll put that in there too. Okay, so those two together. Now, coming down here, all three of those have to be added in. And just to kind of give you an idea of where this is going, this is going to be what's going to be shown on, let me hide this for a second. you know, when you read these financial statements, the consolidated ones, all you're going to see are the totals. You're not going to see all this stuff. So,
Right.
yeah, Amy's statements, Bill's statement, but the consolidated ones will just be the totals.
Mhm.
I'm going to check a couple of those just to make sure there's no error in there. Okay. And the investment should go down to 0. So this should be that 9,600 minus that minus those two, and yeah, it comes out to 0. And if you're wondering why these two don't add up to that,
Right.
remember that the 9,600 is, is part of this, is the 9,600. Yeah, this is actually, it really is the 3,600, and the stock is all at the book value, so those are equal wash.
Okay.
And so the only thing, if truthfully, the thing to get added, it would be 36,000 plus the liabilities, basically. Yeah, it's kind of weird.
Yeah. Not used to things not balancing like that.
Well, we'll see if it balances. Well, we'll hope it balances. Okay, now, so coming down here, we're going to add the liabilities together. Now, this is gone.
Right.
One of the things that you're going to kind of see in here. The only thing that's really left for stockholders' equity is this. This really, there isn't any external shareholders, so those are all going to go away. So the only thing left is
Right.
just the that. And that is why the liabilities, plus the owner's liabilities and equity is the only thing that really adds up. So basically, the liabilities and equity side is going to go up by the liabilities because this is going to be gone. That's why it's basically adding 4,320, which is exactly what is added to that. It's kind of strange. I mean, it's really the first time seeing this. It's got to be weird. So this is the
Yeah.
So this is what it would be on there. So this is the consolidation. This is what they would show for the consolidated total.
Mhm.
That would be it. And now in the details they would have, I'm sure they would show both the financial statements as exhibits, so you could look and see what they actually happened. But you're not going to see those all this stuff. And so in a large company, if you look at Ford will have their own financial statement, and they'll have a consolidated financial statement. And the consolidated financial statement will always be bigger. It may not be more profitable or anything like that, but it's, just because they have to take all these other companies that they own and put on the books.
Mhm.
Now, if the company is dissolved, like we did for some of the first ones, you don't have to do this, because they'll automatically, everything will be in here at the fair value. In the company.
Right.
But if you keep them separate, yeah. You have to do this consolidation thing.
Right.
Now, one of the things that we're gonna, when we were when we did the equity method, we really, the reason we did that is virtually every company will have a consolidated financial statements, will keep their books using the equity method. Now, in this case, it doesn't really matter because we just bought the place, and it doesn't matter what method you use at this point. But almost all companies use the equity method. And the reason I say that, sometimes the books will say something like, that they didn't do any journal entries for the company for the year, and so they have to make other journal entries and stuff. I've never seen that happen. And it'd be very strange to have, for instance, collecting dividends. You get checks in the mail and make no journal entry for it. How are you going to deposit it? There's got to be something on the other side of it.
Right.
So anyway, the common way is that they use the equity method, and that way usually there isn't too much. It should come out, without too much fussing around. It should come out pretty nicely using that method. Okay. So that is the first one. And so what we had to do is we had to get rid of the stockholders' equity because it doesn't exist anymore.
Right.
And we had to add on the excess assets.
Right.
All right. Let's go to next page. Next hand I get. It's not so jammed up. Where did I go down to here? 2.
Yeah.
Okay. And this is someone we just did. They're going to have goodwill in this.
Right.
So,
Okay.
all right. So what we're going to do is get the. So these are the assets at fair value. So those are what they're really worth. The ones we identified. We also have these. Oops. Let's try this again. We also have these liabilities that are on the books at their book value. So these are on the books. They're the same as the book value, which is again very common. Let me just. Hey, look at that. Oops, that's not right. Okay, so these are the liabilities. Hey, I didn't capitalize that. And so these would be the. So if we paid, so this is the, I forget what color I use, yellow. If this is the net identified assets,
Mhm.
we paid that. Well, the goodwill, which is sort of the unidentified assets.
Right.
Oops. Will be 42 minus 42,400.
Mhm. So just minus the 4,000 or 40,000.
Yeah, it easily call this consideration. Consideration 42,400. Lawyer term. And the net 40,000. And so this would be goodwill. Okay, so the goodwill is 2,400 on it, and again, it's usually because they're making they're more profitable than a normal company is with those assets, whatever assets they have. Okay, so excesses. Now I'm gonna move this all over. Well, the excess assets we have are uh, okay, so okay, I think we're ready. All right, so first thing we're going to do, so we have this 42, this investment. Where did I make that one? Didn't make it any color. Okay. So it's 42,100. If we just smash them together, we're going to count it twice. We don't want to do that, obviously. So first thing we're going to do is get rid of
Right.
stock. $34,000. And you can kind of see that in this too, because if this is if the identified assets at fair value is 40,000, but the excess was 6, that means it must have been on the books at 34. So that's what that 34 is.
Oh, I got it.
Yeah, it's 40,000 minus that, the excess would bring it back to book value. All right. Okay, now assets. $1,000, $2,000, $3,000. That was nice of me to make them that. It's the nice thing about making your own problems up. What's wrong? Now there actually is one more asset we got to put in the books.
And that's the goodwill. No, we don't put the goodwill on the books though, right?
You do actually. That is right. Yes. Goodwill at 2,400 on the books.
Okay.
So people forget that one a lot.
Yeah.
And then they'll email me. When does it balance? It's off by the goodwill. Put the goodwill back on? No, I didn't. Oh, you gotta do that.
And that's because these are the consolidated balance sheet, which doesn't doesn't go public and all that.
No, it'll go at the if it's a publicly traded company though, it'll be given to the public. Yeah, and if you think about let me just highlight this thing. Okay, if you think about it, these are the assets they put on the books. Either the 6,000 are the identified assets, but this goodwill is the additional unidentified. It is an asset. Just like McDonald's makes more money.
Right.
Than a normal burger place. So it isn't like it doesn't exist. It does exist. It's just not tangible. All right. And that should come out to, okay. So then we just jam them together. And we another thing is a lot of times people will get the goodwill on the books, but then they don't put it in the total. So make sure you put it in the total. All right. So that plus that.
Right.
Hopefully this comes out to 0. And yeah, and goodwill is just like any other asset on our.
Sorry, I got kicked out there.
Hello.
Hi, sorry about that.
No problem. So I'm gonna see here, hold on 1 second. Okay. There we go. Oh, I gotta go. Did I do that right? Hold on. I didn't do that right. He's in the wrong spot. Oops. Okay. Yeah, so if you kind of look at this, again, the total assets are 152,400 for Amy. But if you look at this other side really only went up by 18,000. So at least for this one for right now, oops. These two basically are the only difference in total. Yeah, I just made it more confusing, I think. How come these are so light? Unless I did something wrong here. Well, my invisible lines. All right, so yeah, let's get rid of those. All right, so coming over here. Yeah. So so this would be the that's what it looked like, the consolidated. And then after they put those financial statements out, these would all be reversed. And these are only on Amy company's consolidation. Bill companies just they're just operating like they've always been. Question on that?
Sorry, I was muted. I was going to say, so do they So if Amy, so Amy puts all this on their books. Bill, if they're bought in 100% by Amy, what do they put on their books? If they're not dissolved, nothing.
Nothing. They just operate. They make their own financial statements, but nothing else changes.
Oh wow. Okay.
Yeah. So, and you may have a whole bunch of these companies, but since Amy Company owns them, it's up to Amy Company to put out the consolidated financial statements. So, Bill Company doesn't own. Well, actually, I guess theoretically, you could have companies that own other companies that own other companies. But yeah.
Yeah. It's only like 3 companies left anymore that make food,
That's right. Yeah. Yeah. It is kind of wild. But yeah, so so these will be in. I should pull up a. I think I used to use Ford, but their financial statements got kind of messy lately. But I'll find it. Their companies own a whole bunch of other companies. A lot of times you can, you'll see like the company's financial statements, and the consolidation is usually can be up to can double the size of Liz, basically. Wow. Because they may have 9 or 10 subsidiaries that they bought. So. And by the way, there are some limits on what. Oh, I didn't put the. How big of a company it is and all that kind of stuff. Because sometimes they don't do consolidations if they're too small. But we won't worry about
that. Okay.
So that is that. And I think for the consolidation part, I'm going to stop there, but I want to go into the next one just to
let's do it.
Because I want to set it up because I think in the past I haven't set it up, and that's not been good. Let's go to the Chapter 3 handout. I think I put it in Excel. Oh, you got to print it. Okay. Well, I think and here's what. Well, let's take a look at a problem, and I'll kind of show you.
Let's do it.
Here's the problem with new consolidations for a company that's if they bought it, say, a year ago, and that is you have this income statement now. They've operated for a year. They have money coming in, money going out. So they have an income. Both Bill Company and Amy Company can have an income here. So this is problem 2.
Oh, okay, I was looking at problem right. Looking at the wrong problem. There it is, problem 2. Okay, I got it.
Yeah. So, and by the way, the stuff for Chapter 3, the first page is on there too. It's
right.
Similar to what we did before. Well, so here's the thing. Now, this retained earnings ends up going down here. This ending number. Oh, wait on. They'll have their income for their business, whatever it is here. And they'll pay out the dividends. Now, you remember about the dividends for the equity method. We own the whole company. So when they pay us dividends, it doesn't really mean anything to us.
Right, because it's the whole company.
It's a wash, right, yeah. We have more cash and our company is worth less. So anyway, the biggest, not the biggest, but one of the bigger problems that we have, though, theoretically for you to think about is this. This retained earnings really doesn't exist. because none of this stuff exists. None of the common stock, additional paying capital, and retained earnings.
Oh,
None
right.
none of that exists. So we eliminate. Now, here's the thing, though. We eliminate everything as we go along. For instance, this bill company, we're going to take their revenues and their cost of goods sold and all this stuff.
Right.
If we're doing the equity method, we've already accounted for their income.
Mhm.
The income's not going to change, but some of the other stuff. And so that income that comes down here is going to really just disappear. Basically, the dividends will disappear, and the retained earnings will also disappear. So
Okay.
there really will be nothing left there. So it's kind of a strange. The rest of it, I think, is not too bad. It is, sort of, I don't want to say straightforward, but it's theoretically a little easier to think about.
Mhm.
Okay. So, I got this one all laid out. Yay! No calculations. All right. Well, we could have done them. Okay, so another thing. Now on these, I usually kept these the same. For the most part, most of the accounts are the same. But
Right.
these can also change throughout the year, though. So just be aware of that. All right, so they tell us that the total assets at fair value was 290 here.
Mhm.
We took out the liabilities, and so the net identifiable assets at fair value was 200,000. We paid that. We paid 225. So the goodwill must have been 25.
Yeah.
The excess assets are already given to us.
Right.
Liabilities are good to the book values. Okay, so I think we're ready. You know what I'm going to put over here, though? I think I'm going to put the Sadie thing over here. That's what I should have put. I'm going to close this one out. Okay, I'll put it here, I guess. Okay.
Yeah.
A little formatting. There we go. Okay.
Yeah.
So Sadie, so this is what we're going to do. We're going to do the stock and assets, just like we did before.
Mhm.
Those are the same. And then these are all the new ones.
That's closing the dividends and the income and the anything else.
Yeah, the additional expenses, because this building is, we put on books for 20,000 additional amount. So if you look down here, oops, they have buildings on the books at 45,000.
Mhm.
And we say at fair value they're 65, so with an additional 20,000. Well, we have to depreciate that additional 20,000
Over the 10 years.
Exactly.
Right.
They're depreciating at 45,000, which they should, but we have to, because the fair value of it is higher. We have to depreciate the additional amount. Okay. So Now, the the stock that we're going to take off the books is going to be up here for the retained earnings. This retained earnings really isn't going to exist at the end, so there's not going to be an
Right.
elimination down here. It'll actually be taken off up at the top. Okay. Okay, so we are going to debit for 65,000. I forget what color I made those before.
Mhm.
It probably doesn't matter. Oh, hey. That's right. Okay, so the stock, so that'll be the stock there. And I'll come down here, and the common stock additional paid in capital, those won't change because there's nothing out there.
And those don't exist because we bought 100% of the company, or Amy bought 100% of the company, and so there's no stock and no paid in capital, right?
Change the color here. Change it, okay, yeah. So we bought 100% company, but now here's the thing: even if we didn't buy 100%, we would still take 100% off out, and then we'd add back in a certain amount. I know that sounds very strange, but yeah, that's why we, for accounting purposes, they say, okay, how much in assets do you control? If you own 55% of the company, you control 100% of the assets. So they always put 100% on, and then they'll back out the other. So if we bought 55% of a company, we would put 100% of the assets on the books, but then we would back out saying, okay, there's this other 45% that someone else owns.
Okay.
We would adjust it for them. They used to call it minority interest, but I think for political, for whatever, they now call it non-controlling interest.
Non-controlling interest.
Yeah.
And that's for the 45% that's owned by some other company or multiple entities, presumably.
Exactly. Yep. And so yeah, so this is going to be our stock coming off the books. That's S. Oops. S. Whatever that is. $170,000. Yeah, and you can kind of see that up here too. It's 170 because it's if you add these up, 30,000. So if the identified are 200, but these are excess,
Okay.
that's why it comes up to 170. Yeah, I had an instructor that used to call consolidations unmixing the cake. It's kind of like you're going backwards, taking everything out that you put it in
Oh, that's too funny.
there. Okay, so assets, kind of like what we did before, land and building. Let's see here. So land and building get an extra 10,000 and 20,000. Oops.
And those are assets, right?
Yeah. And there's one more asset we need. Excuse me. What's the one more asset?
Let's see. It's not, we don't have, or do we have goodwill?
Yep.
We have goodwill.
Goodwill. So this will do. You know what I should do? I should make this the same as the other edition.
Oh, that's right. The 20, you know, and I have it, it's literally written on my paper, but I was like, no, we couldn't possibly have goodwill. Okay. Yep. 25,000.
Okay, so let's see, that would be an A. Oops. 55,000. Yep. Okay, so we got rid of those two. Now, remember this investment account.
Right.
When we got paid the dividends, we subtracted it out.
Mm-hmm.
Okay, so we said, okay, this investment account is worth $5,000 less. Well, we're trying to reverse everything out. So we actually got to add that back in and then take off the dividends up on top here. We'll do in a second. So for dividends, oops, the 5,000 that we subtracted, remember we're reversing everything back out, that, you know, kind of unmixing the cake.
Right.
And we're going to take it off up here. 5,000. And let me come up with a color for that. That was too close to the other one. There we go, out of orange. Okay, so these dividends are going to go down to zero. Because if you think about it, the only dividends that were really went out to anybody was the 60,000 that the parent company put out. These 5,000 of dividends weren't paid to anyone,
Mm-hmm.
anyone outside of the parent company. So the only dividends that shareholders actually got were these 60,000. So we're going to take off these 5,000. We're also going to, and this is another little bit strange, we're going to add that back into the investment. Why? Because we subtracted it out before. So we actually are kind of unmixing that, everything that went into that investment.
Mm-hmm.
Okay, so say where are we at? Sad. so far we're sad. Income. Okay, so the income we have to take off, and remember this income, the income gets added to the investment.
As a credit.
So the income that we put on the books here, $19,000. We have to take off. And by the way, I put the normal balances over here. Normal balance for the equity investment income. The normal balance would be $19,000 on credit, so we're debiting it to get rid of it.
Right.
And the hardest part is figuring out what color to. We'll make it purple. How about? There you go, purple. Okay, so
So it's debited on the income statement and credited on the balance sheet.
correct. Yep. Yeah, it's taking out of income and it's taking it out of the investment. So we really are kind of unmixing the investment. And at this point, the investment should be completely gone. And the reason I say that is because the last one is the additional expenses. Okay, so we've got up through here. So that's kind of funny. There we go. So this last one, additional expenses. Okay, well that comes about because of this. The land isn't going to depreciate. Land is going to sit there like a lump. But the building, the extra 20,000 of the building, they only had 45 on the books down here.
Right. But we gave it 20 more.
Exactly. So we also have to have a depreciation expense. And so the building excess. Oops. Okay, building excess was 20,000 divided by 10 years, right?
Right.
By 10 years. Equals, hey, it didn't show my dividing.
2,000.
Yep. So this is going to be our depreciation expense. Okay, so coming up here, depreciation expense, this is a debit. Now, we are going to debit that because we want it to be higher. This is the depreciation. Well, this is the bill company depreciation expense, assuming it was at 45,000. But we have to add an additional 2,000 of depreciation expense onto that. And by the way, this you can kind of see this is how we got to 19,000. Bill company made 21,000 of income.
Oh, but then it doesn't include the depreciation for year one.
For the excess
Okay.
one. So that's why it's we only had 19,000 on the books because we subtracted out that. Now this has to come out of the buildings. These are net depreciation, so this will have to come out of the buildings. What a mess.
Yeah.
Well, luckily most of this stuff drops out.
Yeah.
So those are the consolidating entries.
Mhm.
And so let's go through, and this it does get actually even a little more confusing down here. Now, well, we didn't have any amortization expense, but so this stuff's all going to drop out. This is going to be taking them and adding them together.
Mhm.
And just for my own purposes, I usually will put all the negative stuff together as a minus.
Okay.
So for instance, the cost of goods sold, that's goods going out. Depreciation expense. Same way, except for and this is, well, we never did have anything in amortization, but this is 0 for the investment income. Because we've included their revenues and their expenses, cost of goods sold and expenses up here. Now, if you do this right, it should come out to be 79,000. It should come out to be the same as that. Yay.
Okay.
Because we already accounted for that income and all that, but you'll notice that these consolidated numbers are, larger. And so when we do the consolidation, it's just going to be that.
Right.
Even though the income would be exactly the same as the Amy company, it'll show the additional sales and cost of goods sold and all that stuff on there. Okay, coming down here. Now, retained earnings. Basically, this is only going to be the retained earnings for the parent
For
company.
Amy, yeah.
And these are really the only things that are going to be left. Are these here? This is a little harsh. Oh, it doesn't matter. So anyway, maybe it does. There we go. So the only thing that's going to be on the books, this 65,000 is gone.
Right.
The retained earnings is gone. The income of 21,000 is gone.
And the income is gone because we disappeared it off the income statement, right? With the 2,000, the 19,000, and then the 21,000, and those all canceled out. And so that's why that cancels out on our retained earnings.
Yep, that's exactly it. Yeah, see, this 21,000, it doesn't exist anymore because the 79,000 includes it.
Right.
The 79,000. So this is actually gone. This has disappeared.
Okay.
The dividends disappeared. Again, that's one of those things I usually like to put a negative in front of, just because I don't know. But anyway, so this will be. You'll notice that these are exactly the same. Well, let's make it a little bit easier to see. These are exactly the same as these. The retained earnings don't exist anymore for the subsidiary.
Right.
So only the parent stuff exists. This stuff is of the same. The only thing to be careful of is this 20,000 adds to the buildings, but this 2,000 subtracts from it.
Oh, right.
So. $65, $85. Yep. And the moment of truth for the investment. Now remember, you got to add the 5,000 in and subtract out all the rest of them. Yay! So this, we want this to be gone, and it is.
Mhm.
We still have the goodwill.
Right.
So I think. It's kind of funny, like, after all that, you say, okay, so the total assets are this. But really, it's just the same as adding those two onto it. I mean, these are the only things that are changed in the equity section, the liability and equity,
Right.
I should say. So really, it's just the 769 plus the liabilities. And again, kind of like up the top there, these are the only thing that's left is the parent company's equity section.
Right. Just that all disappeared.
Yeah, exactly.
And the 81,000 disappeared up by the retained earnings, and that's why we're not carrying that over. Right.
All of this is basically gone. The 65 is gone, the 21,000 is gone, the 5,000 is gone. So really, these all go down to zero. So this would be 02.
Mhm.
Put them all together. It is kind of strange. I mean, the strange part are the retained earnings and the income are because they appear in more than one section.
Right.
That's the problem. That you don't want to eliminate them twice. That would be double counting the same thing. So right now, hopefully this comes out to yay.
So the balance sheet and the total liabilities and equity should always match, right?
Yes. So these should always match. Yeah, and yeah, this is what we've shown on there, consolidated. But yeah, they should always match, and every student's different. But if you do run into a problem where they don't balance, the big ones to look at are goodwill,
Mm-hmm.
the expense, and sometimes the ones that don't have any adjustments to them. I've given tests, and they had accounts that didn't have adjustments, and I think because they don't have adjustments, you think, okay, there's nothing going on there. Well, they still exist,
Right.
So this equipment still exists, even though it's not,
Right.
there's no value adjustments for it. But yeah, so yeah, I tell you what, how about for homework? You try problem 3
Perfect.
on your own. So next week we'll tune in and see if you can work that one out. If you get stuck somewhere, feel free to email me or text or whatever, and I'll go over it. But oh wait, you know what? This one is more difficult. It just hit me. I tell you what, we'll figure out the let's together figure out the goodwill.
Okay.
And then unless you want to do it, you want to just do it on your own?
Yeah, I could give it a try. I don't.
Okay.
Yeah, I think that should be fine.
Okay. All right. Well, we'll do that then. So
Would it be?
Go ahead.
Oh, I was gonna say, would it be possible to meet earlier in the week next week instead of Friday?
Yeah. What day?
Monday, Tuesday, whatever.
Yeah. Either one is fine with me. I got a class at 6 o'clock on both of those.
Okay.
So,
Well,
but
I can finish work as early as 2:30, so.
well, but even you know, we usually don't take more than an hour and a half, anyways.
Yeah.
But yeah, whatever works for you, it'll work for me.
Okay, how about like 3:30 on Monday?
3:30 Monday, very good. Yes,
Okay.
so that'll be fine.
Okay, and I'll have this problem at least worked on, if not completely balanced.
Okay, all right.
Perfect.
All right, I'll see you on Monday then. And make that a permanent change, I assume? Or no? Or just,
Oh, actually, yeah, let's do that. That would probably be easier. Yeah.
Quite honestly though, if it doesn't work, you know,
We can move it around again.
The only thing I have 6 o'clock classes on Monday through Thursday.
Right.
So any other time, you know, is
Right.
so you know, and if on Monday doesn't work and Tuesday works, you know.
Yeah. All right, yeah, we'll switch at least for now to 3:30 on Mondays. That's perfect for me. And then do I have anything for chapter 2? Quizzes, practice tests, whatever.
Turn in
I did the chapter 1 stuff.
did I put a drop for those? Maybe I didn't. So chapter 2 is just I'm just going to have the oh, you turn. I actually.
I uploaded them like an hour before we got here, so I don't expect them to be graded.
Okay, yeah, the only thing I'm gonna have you turn in is the chapter 2 handout.
Yeah.
And I think we'll jump in right into chapter 3 because this is kind of the big part of the class. So
Right.
yeah, so I'll put a drop for the to submit the chapter 2 handout. And by the way, you can submit it. It's unlimited submittals, so you can put in 10, whatever. So you do one, you know, part of it in Excel, part of it by hand in a notebook or whatever. You know, just take a picture and send in. I can figure it out. So
Yeah, perfect.
yeah, so you yeah, don't worry about turning it in. It doesn't have to be in any certain format.
Okay.
So, okay, well, I will see you at 3:30 on Monday.
Perfect.
All right.
Thank you.
Very good. All right.
Bye-bye.
Have a good evening.
You too.